Good morning, everybody. For those of you that don't know, my name is David Mott, advisor here at Nexus One Financial, giving you the weekly update on the insights of our investment committee, what happened the last 5 days in the market, what we see going on in the future. Bit of a pullback. S&P down about 1%, much different story for the NASDAQ, down about 4%. Year to date, both wildly profitable. S&P is actually beating NASDAQ. Year to date, S&P up 8%, NASDAQ after the pullback only up 7%. We got a monster earnings week, very much tech related. A lot going on there that we have to unpack. In addition, a couple of other items. Oil continues to rock and roll. What does this do to inflation? And ultimately, what does all this mean for your bottom line? Let's dig in. We are in the midst of the tech earnings week. Google has already announced its earnings. Microsoft, Meta, Apple, Amazon on the docket for the back half of the week. Let's unpack that. There's a little bit of a tremendous pullback going on in tech. Earnings are largely okay. When it comes to the stomach, though, for this continued AI spend, that's where Wall Street is looking for some sort of silver lining to find an advantage. And there's a little bit of nitpicking going on when it comes to it. Tech earnings are largely strong. However, the earnings can't be good. They need to be near perfect. And what I've been telling a lot of clients right now is this is almost a gut check week when it comes to your tech. It's a gut check. These pullbacks tend to happen. Wall Street is always looking to take money off the table. Important to do your homework. Even though much of tech companies across the board are pulling back, some of it is warranted. Some of it is business cycle. And we'll use an example. Two companies that announced recently, Google and Tesla. Google posted nearly a 25% increase. Investors were not thrilled, though, on the CapEx it spent. So the inflows and the revenue beat expectations, up 25% nearly, but a lot of spend going on. Focal point was something called free flow cash. Make it very simple. In the last quarter, how much money did you bring in versus how much went out? And for the first time in a very long time, Google was negative. Not because they didn't bring in money, mentioned they were up 25%. They made tremendous investments in capital expenditures in the AI field to the tune of about a $6 billion negative free flow cash. A lot of investors use that as an excuse to pull some money off the table. But in reality, Google is sitting on about $240 billion of free flow cash. Do we really care about the extra pull of $6 billion? And this is where the homework really plays in. Does Google really have an issue long term, or did they simply make an additional investment for the future? That dictates the short term versus long term play on Google. A much different story when it comes to Tesla. Investors were not thrilled with a lot of the balance sheet items when it comes to Tesla, primarily the length of time it's taking robo-taxis to roll out. A new product that had Wall Street excited is taking longer than expected. That's a little bit of a move on the balance sheet, and maybe that pullback is more warranted than some of the other tech companies. So this is a gut check time. This is a do your homework time, assuming you are doing it yourself. If you're one of our clients, we are absolutely doing that for you, weighing why these pullbacks are happening, whether they're justified in some areas, and whether there is a cause for a move. Now, this segues nicely into something I've been talking about in previous videos here recently, rebalancing. Are you properly rebalanced? For those of you that are our clients, absolutely. We take that rebalancing into consideration. We are doing the homework. Most other advisors absolutely are, should be rebalancing for their clients. If you are unsure if your advisor is, highly recommend picking up the phone, giving them a call. For those of you that DIY, the do-it-yourself investors, this is a good time to look in the mirror and make sure that you are doing the proper homework and that you are rebalanced and you have some good justification on why you're invested in the instruments that you're invested in. So a lot of great earnings coming out on the tech side, not so much on others, but Wall Street keeps pulling back. Texas Instruments, Google, Intel, all beating expectations, some a little rockier. We have a number of big ones on the docket. Microsoft, Meta, Apple, to name a few. Some interesting plays there. Wall Street is closely looking again at the CapEx spending in AI. Would say that Meta has a little bit of a layered onion. The timing isn't working out well for Meta because there are a number of ongoing litigations and lawsuits. Feels like every state and school district currently has open litigation with Meta. Will Wall Street focus on that? They've largely ignored focusing on the AI section of their earnings report. But again, as we have viewed with Google this week, Wall Street is looking for an excuse to take some money off the table when it comes to tech. And is this the ammo they need when it comes to Meta? Something we're watching very closely. These earnings reports have a lot of weight in the market and something we're following closely. So a lot of these big tech companies have great earnings. They are beating estimates in a number of spots. Their revenue is growing, but there's still a tremendous tech pullback. What's going on? And what we're seeing is Wall Street doing a little bit of hedging because there is still this 800-pound gorilla in the room that is growing, not going away: inflation. Inflation is still sitting at 3.5%. There's a big Fed meeting going on, not spending a lot of time on it because the consensus is should not be any movement when it comes to trying to fix inflation from the Fed. But the stated goal is 2%, folks. Aside from one anomaly around the COVID era, we haven't seen that since 2019. That's a 7-year run of being significantly higher than the Fed's stated goal. And I don't need to tell a lot of you this. You buy the same cars I do, you shop at the same grocery stores. Things are getting very, very expensive. With the conflict in the Middle East continuing to drag on, oil popping back up to the mid 80s, and I've said this in previous videos, nothing good happens in the world when oil is above 75 bucks a barrel. It's sticking. And we're starting to see inflation go in the wrong direction. And that is where Wall Street taking a little bit of money off the tech table, which we're seeing this month, turns into a bigger ripple effect if the Fed is forced to tackle this inflation. I know the stated goal is 2%. Most of us in the industry don't believe it. They'd be happy with the low to mid twos, but at 3.5% and sticking around, tracing higher, that has Wall Street somewhat concerned, and justifiably so, because as inflation continues to grow, bump up, that forces some Fed moves that truly can debilitate the market. Not saying it's there yet, but as the conflict continues to escalate and oil stays high, the likelihood of inflation growing also stays around. It's something we're monitoring very closely. Having a defensive strategy, if you will, something to pivot on, is something very important should it come to that. Again, tech is strong, Wall Street taking earnings off because of this undertow we have going on called inflation. So, a lot going on in the world. We are monitoring it closely. Hopefully, you are as well and doing your homework. If you are not working with an advisor, do not skip out on the homework. We appreciate putting out this content. To make sure you don't miss a beat, be sure to like and subscribe so you don't miss any future videos. We look forward to putting more content out, and we'll see you next week.